May the 6th, 2025, and welcome to the 32nd edition of FinWell Daily Brief.
Great to be here.
Let's dive straight into an amazing financial fact. This really paints a picture of how India is investing today. Get this, more than half, over 50% of all the fresh, brand new investors who started their mutual fund journey in the financial year 2024-25, specifically between last April and August, weren't from Mumbai, Delhi, Bangalore, the big top 30 cities.
Wow, really?
No, these folks were joining in from smaller towns and cities right across the country. Isn't that incredible?
Yeah, it is incredible. It's like the roots of financial participation are spreading everywhere.
Exactly. Truly democratizing investment.
Now, with that fantastic news energizing us, let's see what the market numbers have to say from today's closing bell.
A vibrant start indeed. And yeah, this broadening of the investor base is a really significant trend to watch.
Definitely.
Now, focusing on today's market close, the Nifty 50 ended at 24,379.6 a year.
Okay.
Registering a slight dip, about 0.33%.
Just slight, okay. But the mid-cap segment, that saw more significant selling pressure. The Nifty Mid-Cap 150 closed at 19,646.20, down by 2.01%.
Ooh, okay. That's a bit more noticeable.
Yeah, and the small cap space also experienced a notable correction. The Nifty Small Cap 250 finished at 15,181.45. That's a fall of 2.23%.
So mid and small caps took a bigger hit today then.
They did. Looking at the overall market picture, the Nifty total market closed at 12,318.80, down 1.13%.
Got it.
For those of you tracking the bond market, the yield on the 10-year government security, or GSEC, is hovering around 6.35%.
Pretty stable there.
Relatively, yes. And in the currency market, the USD-INR pair closed near 84.43 rupees to the dollar, approximately 84.4 overall today.
Okay. So what were the key factors? What drove these movements today? That's exactly the question on my mind.
Right. What were the big stories shaping today's market narrative?
Yeah.
Well, several interconnected factors played a role. On the policy and economic front, we saw Moody's revise their forecast for India's GDP growth in 2025.
Oh, yes, I saw that headline. Downwards, wasn't it?
Downwards, yeah, to 6.3% from their earlier estimate of 6.7%.
And the reasoning?
The reasoning highlighted concerns about a potential slowdown in the global economy.
Okay.
And the looming risks associated with, well, trade tensions involving the United States.
Ah, the usual suspects. Global slowdown, trade wars.
Pretty much. Yeah. Think of it like a slightly cloudy forecast for the global economic weather, which naturally has some impact on our outlook here.
Makes sense. We're all connected in this global village, as they say. What about the domestic picture? Any key events or policies we should be aware of?
Yes, definitely. On the domestic front, the Reserve Bank of India, the RBI, has announced a pretty substantial bond buying program for May.
Oh, substantial.
Totaling $1.25 trillion.
Wow, okay. That's significant.
It is. This move, often called open market operations or MOMOs, is basically the RBI stepping into the market to purchase government bonds.
Right, to manage liquidity.
Exactly. The goal is managing liquidity in the financial system. And it's been a key reason why that benchmark 10-year GSEC yield has stayed relatively stable, around that 6.35% mark we mentioned.
So they're actively working to keep yields low.
Correct. Now, while current inflation levels are moderate, everyone's keeping a close watch on how future government spending and those global factors might influence price levels down the line.
Always something to watch. So the RBI is actively managing things, trying to keep the waters calm. Now, let's zoom in a bit on the bond and currency markets. They seem steady on the surface, but what's happening underneath?
You're right. There's more to the story than just stability. Yeah. The fact that we're seeing consistent inflows of foreign investment into India, that's providing strong support to the bond market.
How so?
Well, when foreign investors buy Indian bonds, it increases demand, right? And that helps keep yields in check.
Gotcha.
So this, combined with the RBI's proactive liquidity measures, creates a supportive environment for our government bonds.
Okay. And the rupee, holding near 84.4.
Yeah, it's been trading in a fairly tight range there against the U.S. dollar. The RBI's occasional interventions in the forex market, plus healthy inflows from exports and other sources, are helping maintain this stability.
And we can't ignore that huge jump in NRI deposits. That's a headline in itself, isn't it?
Absolutely. Yeah. That's a big one. The inflow of deposits from non-resident Indians, or NRIs, has surged by about 23.3% year-to-date.
23%?
Yep, reaching a substantial $14.55 billion.
Wow. What's driving that?
A primary driver seems to be that many NRIs are choosing to invest in what are called FCNRB accounts.
FCNRB, foreign currency non-resident accounts.
That's the one. Basically, fixed deposit accounts held in foreign currency. The likely reason for this surge is that NRIs might be anticipating potential fluctuations in exchange rates.
Hedging their bets.
Exactly. Seeing this as a way to safeguard their earnings. This significant inflow really highlights the confidence NRIs have in the Indian economy and reflects some savvy financial decisions on their part.
That's a powerful indicator of global trust in India. Now let's switch gears. Let's talk stock market. Individual company stories that caught our attention today. Felt like a bit of a mixed bag of news, didn't it?
Indeed, the Q4 corporate earnings season has presented a somewhat varied picture. For example, Kajaria Ceramics reported a significant 58% drop in their profit compared to last year.
58%, that's huge.
It is. And they've also decided to exit their plywood business, which was reportedly facing losses.
Cutting their losses, maybe?
Seems like it. Similarly, the State Bank of India, SBI, a major player, saw its profit decrease by around 10% year-on-year.
Okay, so some big names facing pressure, but not all bad news.
Not all bad. We also had positive news. HDFC Bank reported profit growth of about 6.7%. So yeah, like a tale of different fortunes across different companies.
Clear winners and some facing headwinds then. What about broader sector trends? Did any particular areas stand out today?
Yes, we saw some distinct movements. Shares of PSU banks, government-owned banks, experienced a notable sell-off. Their index fell by about 5%.
5%? Why the sell-off there?
Could be profit-taking, could be concerns about credit growth slowing slightly, maybe linked to those geopolitical worries too. Real estate stocks also saw significant selling pressure, down around 3%.
Okay, so caution in PSU banks and realty. Where was the strength?
On the other hand, the auto and consumer staples sectors showed more resilience. We saw gains in companies like Hero MotoCorp, Mahindra and Mahindra in autos,
Right.
and Hindustan Unilever, HUL, in consumer staples.
Interesting contrast.
It really underscores the selective nature of the market right now,
Mm.
investors favoring certain sectors over others.
So it sounds like this mix of company results and maybe, well, what some consider high valuations in certain pockets, it's really testing the waters of investor sentiment.
Precisely. Investors are carefully scrutinizing how companies are performing relative to expectations and their current stock prices.
Now let's take a look at commodities and currencies. Gold saw a pretty noticeable jump today, didn't it? Almost like a classic reaction to global uncertainty.
Absolutely classic reaction. Gold prices experienced a significant jump, approximately 1.2%, reaching around 3,372 pounds per ounce.
Highest in a couple of weeks, I read.
That's right. The primary reason for this surge is heightened demand for safe haven assets. Seems like tensions between the U.S. and China are maybe escalating again.
The trade tensions rearing their head again.
Looks like it. And when there's geopolitical uncertainty, investors often flock to gold. It's that traditional safe store of value. Like when a storm's brewing, people look for shelter, right?
Makes perfect sense.
Yeah.
And oil prices, they seem to be going the other way.
Yes, oil prices actually eased today. Brent crude, the international benchmark, fell about 1.7% to around $60 new 2 cents per barrel.
Okay.
And WTI crude, the U.S. benchmark, was down about 2% to around $57.01 per barrel.
Why the drop there?
This decline comes after the OPEC Plus, the oil-producing nations, agreed to accelerate their planned increases in oil supply.
More supply coming online faster.
Exactly. So this suggests we might see some stability, or maybe even a slight decrease, in fuel costs in the near term. Could have knock-on effects across the economy.
Okay, so a bit of a mixed bag in commodities, too. Gold up, oil down. Now, before we delve into what the future might hold, I want to talk about something crucial for every investor listening, a fraudulent practice called front-running.
Sounds complicated, maybe.
It can sound that way, but it's actually quite a simple and definitely unethical scheme.
Let's break it down then.
Okay. At its heart, front-running is deceptive. Imagine this. A broker or a trader gets advanced knowledge, inside info, that a very large client, maybe a big mutual fund, is about to place a substantial order to buy a particular stock.
Okay, they know a big buy is coming.
Right. Now, instead of just executing their client's order properly, this broker decides to, well, get ahead of the game for their own benefit. They secretly buy shares of that same stock before their client's big order goes through.
So they're using that private information about the client's big trade. Exactly, to make a quick buck for themselves. It's like knowing your friend is about to buy out all the concert tickets, so you secretly buy a bunch beforehand to resell them at a higher price later. Not cool.
Definitely not cool. And illegal.
Highly illegal. Because the broker buys before the large client order hits the market, Their own purchase, combined with the client's subsequent big order, often pushes the stock price up.
Naturally. Supply and demand.
Right. Then the broker can sell the shares they bought earlier at a profit, all at the expense of their client, who ends up paying a higher price because of the broker's actions.
That's terrible. So it's basically a form of insider trading.
It absolutely is. They're acting on privileged, non-public information about their client's intended trading activity. It's a serious breach of trust and market rules.
Absolutely unfair. So what practical steps can our listeners, the everyday retail investors, take to protect themselves from this kind of thing?
That's a vital question. As retail investors, you should be wary. Be suspicious of any unsolicited tips or sudden, unexplained price moves that seem to predict major news or big trades.
Okay, beware of hot tips.
Definitely. Always ensure you're dealing with brokers and financial institutions that are regulated and have a strong, clean reputation.
Use regulated players. Got it.
Keep a close eye on the timing of your trades. Check those timestamps on your contract notes. If anything seems off or out of sync, don't hesitate to ask questions.
Scrutinize the details.
And be particularly cautious of anyone who pressures you. Pressures you to make quick investment decisions based on supposedly confidential info or promises guaranteed high returns with a strong sense of urgency.
Right. The act now or miss out pitch.
Those are often major red flags.
Excellent advice. Anything else our listeners should keep in mind?
Yes. Just remember that old saying. If investment opportunity sounds too good to be true, it probably is.
Always good advice.
Be skeptical of any advice that lacks a clear rationale or relies on some kind of secret information. And importantly, if you suspect you've witnessed or been a victim of front-running or any other suspicious market behavior, report it.
Report it where?
Report it to the relevant stock exchange, like NSE or BSE, or to the regulator, SEBI. Your vigilance plays a really vital role in maintaining market integrity and fairness for everyone.
Important points to remember. Okay, let's shift our focus now. Look ahead. What might the coming days bring for the markets? What key factors and events should we be keeping an eye on?
Looking ahead, global cues and significant policy developments will likely take center stage this week, in particular the U.S. Federal Reserve. They're scheduled to announce their monetary policy decision tomorrow, May 7th.
The Fed meeting, always a big one. What's the expectation?
The broad expectation is probably a pause. They'll likely maintain the current interest rate.
Okay, no change expected.
But what the market will be intensely focused on is the commentary that accompanies their decision.
Reading the tea leaves. What are they signaling?
Exactly. Investors will be parsing every word for any signals about the future path of interest rate cuts. Recent U.S. economic data showing continued strength in services and a rise in an inflation gauge. That suggests the Fed might adopt a more cautious, sort of hawkish stance.
Which could mean what for us?
It could potentially put some upward pressure on the U.S. dollar, which then has ripple effects.
Got it. And bringing it back to India, what domestic factors are in play?
Here in India, the RBI's ongoing bond buying program, those almos we discussed.
Right, the 1.25 trillion.
Yes. That, along with the steady growth in bank deposits, especially those robust NRI inflows, that's expected to continue to help keep a lid on longer-term interest rates, keep them from rising too much.
So domestic factors supporting stability in rates?
Generally, yes. We've also observed a slight moderation, a bit of a slowdown in domestic credit growth. And this factor, maybe combined with those persistent geopolitical uncertainties globally, likely contributes to some of the cautious sentiment we saw in PSU bank stocks today.
Connecting the dots back to the PSU bank sell-off. So perhaps a more cautious outlook for certain market segments near term.
That's a fair assessment, I think. We maintain a somewhat cautious outlook on cyclical mid and small cap stocks, as we saw today with their roughly 2% fall.
Yeah.
These segments can be more sensitive to shifts in market sentiment and the economic outlook.
Yeah.
Similarly, companies and sectors trading at very high valuations might also feel some pressure if market sentiment turns more risk-averse.
Makes sense. So where might investors look for potential areas of maybe relative strength or opportunity then?
Well, we believe investors might start to focus more on sectors that demonstrate either strong underlying sort of structural demand or significant pricing power, the ability to raise prices.
Exactly.
This could include the auto sector. It seems to be benefiting from improving demand in rural areas and relatively stable fuel costs. Remember, oil prices eased a bit.
Right. Autos. Okay.
Select companies in consumer staples, the everyday essentials. Those tend to be defensive. And also IT and pharmaceutical companies, especially those showing strong and consistent earnings growth. Those could be attractive areas to explore.
So autos, select staples, IT, pharma with good earnings. And with global uncertainty still lingering, what strategies might be prudent for managing risk?
Yeah, given the ongoing geopolitical risks. The various global tensions, high gold prices, oil still relatively high despite the dip, it might be wise to consider including some more defensive investments and hedges in your portfolio.
Defensive plays. Like what?
This could involve allocating a portion to gold, as we saw investors doing today, or perhaps focusing on high-quality blue-chip companies, the big, stable ones that tend to be more resilient during market volatility.
So the overarching message seems to be stay informed, be selective, maintain balance, maybe lean a bit defensive.
Precisely. We'd advise investors to remain patient, maintain a well-diversified portfolio across different asset classes. Don't put all your eggs in one basket.
Diversification is key.
Always. And with current interest rates being relatively attractive, holding some cash in fixed income instruments like bonds or even just bank deposits can provide a degree of stability and flexibility.
Keep some powder dry.
Exactly. And for those with a long-term investment horizon, selectively adding high-quality stocks to your portfolio during market dips, that can be a sound strategy. Remember, building wealth is a marathon, not a sprint.
Absolutely. Now, a quick word for everyone listening. Are you finding these daily market insights valuable? You want to stay ahead of the curve, make more informed financial decisions for yourself? Then make absolutely sure you hit that subscribe button for FinWell Daily Brief. Don't miss out.
It really helps you stay updated.
It does. And for even more in-depth discussions, maybe connect with other savvy investors. Reach out to SOS FinWell on LinkedIn. Seriously, check it out. Don't miss the knowledge that can empower your financial journey.
Great community there.
All right, let's bring it all together now. Key takeaways from today's market action as we wrap up.
Okay, in summary, markets closed lower, in the red today, influenced by a mix of somewhat mixed global signals and some profit-taking here at home, especially in mid and small caps.
Got it. What to watch?
Definitely watch that U.S. Fed meeting tomorrow. Keep an eye on the RBI's policy actions, like the bond buying, and of course the continuous flow of corporate earnings results in the coming days. Those will be critical.
Stay tuned for earnings.
Absolutely. We continue to encourage you, the investors listening, to stay well-informed. Please, avoid following the crowd blindly. That herd mentality can be dangerous. Maintain a strong focus on the fundamental health of companies. Look at their balance sheets. Look at their valuations.
Sound advice. Focus on fundamentals. Stay informed. Be patient.
That's the mantra.
And on that thoughtful note, we leave you with a timeless piece of wisdom. It truly captures the essence of building financial security. Remember, as the saying wisely puts it,
A good one.
every rupee saved is a brick building your fortress of wealth.
Indeed. Powerful words to remember as you manage your finances.
Thank you so much for joining us on